Let's bring in Dennis Lockhart, former Atlanta Federal Reserve President. Dennis, thank you very much for joining us this morning. Let's talk about the foregone conclusion. It's going to raise rates because it has to, right?
It's time. It's clearly time. The inflation pressures are just simply too great for the Fed to stay on the sidelines, and it's time to get going with removing all of this support and accommodation. And I think it's a virtual certainty that we will see liftoff this afternoon.
All right, so it's a live meeting, a lot of anticipation there. It's pretty much been said already. I mean, Fed Chair Jay Powell said it in congressional testimony. It's not very usual for a Fed chair to announce policy before Congress, but he did, so we know what's going to happen. I guess my question for you, Dennis, is if you were still back at the Fed, what does the Fed rate trajectory look like in the coming months if it's going to be 25 bips today?
Well, my base case on that question, Dominic, is in all likelihood they will continue with a pace at each meeting of 25 basis points for the foreseeable future. But I think the uncertainty that surrounds Ukraine, the uncertainty that we're dealing with in the world, means that they're likely to be a little cautious in signaling that, because you simply don't know what kind of world you're going to be in by May 4th, which is the next date at which a policy decision will be made. So they may not really give us a good indication, but I believe 25 basis points a meeting for the next few meetings.
In your experience, Dennis, how long does it take for the American public, for Main Street, to start to feel some of the effects from a tightening policy when it starts, say, today?
Big question, big theoretical question. You know, the mantra that has been used in monetary policy is that monetary policy has its effect with a long and variable lag. That, you know, it has been estimated to be sometimes as much as 18 months. I'm of the belief that that probably remains true, but there are short-term effects where there are adjustments in interest rates that people actually feel. Markets that are interest rate sensitive do get affected in the short term. It's a hard question to answer with assurance, but I think there'll be some immediate effects, and certainly psychologically there will be.
And one other thing that a lot of folks are talking a little bit more about these days is what the Fed is going to do about the kind of balance sheet aspect of its operations right now. This idea of quantitative tightening, perhaps. We were speaking with Priya Misra over at TD just yesterday. She feels as though the market is prepared for interest rate hikes, but it is not yet prepared for quantitative tightening or a real reduction in the balance sheet. Take us through what you think that could look like.
Well, first, I think they will be discussing that question at today's meeting. And maybe at the next meeting, we'll be able to come out with a plan of some kind. It's been under discussion at previous meetings. So it seems to me that that they're getting close to having the details locked in. And then I think they will be very careful, particularly under these current circumstances where there's some concern about financial stability because of the world situation. I think they'll be very careful to explain it well in advance and allow markets to become prepared. So the concern that your interviewee expressed may not be a concern by the time they actually start to implement, because the markets will be well prepared. My guess is mid-year, meaning conceivably start in June or July. That is following on their guidance, if you will, in earlier comments by Chairman Powell.
Sure.
That it will be soon after liftoff that they will implement the quantitative tightening.